welcome everyone for very interesting session on GAAR. And in today's session, we are really going to talk about how one should deal with GAAR in the coming times. We're seeing a lot of change in the tax landscape since the last few years and even going forward. Every day, every other day, there are some new rulings or new development that happens, which makes us question the manner in which, we conduct our transactions and we conduct our business. So today's panel discussion is going to discuss how do we really deal with GAAR in the changing tax landscape. And once again, I welcome all of you to this discussion. We'll start off with just, a very quick introduction of where we are today, where GAAR is concerned, and what really is the, the debate about GAAR as such. We've seen now that, with the MLI or the multilateral instrument coming into effect in India from October of last year, there is also a sort of, thin line between GAAR and the principal purpose test. So we'll talk about that also. But mostly countries actually implement GAAR, or GAAR has been a hot topic of debate, in order to deter skillful taxpayers from establishing artificial structures, which otherwise don't really have much of a commercial rationale, but they've mainly been set up in order to avoid tax, and which otherwise would have been difficult to prevent under a specific anti-avoidance rules. What the question that really arises before a country, that in order to curb treaty abuse, whether the country should insert an anti-abuse provision in its tax treaties, or whether it should really enact a statutory GAAR, which could override its tax treaties. And possibly, the multilateral instrument may have actually put a rest to, this issue as to what a country should really do with, the GAAR being inserted in the form of a PPT test in the covered tax treaties. The BEPS action plan, which was introduced by the OECD and which specifically targeted avoidance of, base erosion, it recognized treaty abuse as one of the most important sources of BEPS concerns. And when the 15 action plans were published by the OECD, the main idea or the main focus was really to curb treaty abuse and to ensure that profits are taxed basis economic value creation. In this context, when the multilateral instrument was introduced as a byproduct of Action 15, there was, the multilateral instrument was really meant to implement treaty-related measures to close loopholes in tax treaties and, to avoid tax avoidance in that context, which has been done in the, in the past few years under the garb of tax planning. So when we talk about India, India has also been, at the forefront of implementing the GAAR rule. GAAR was introduced for the first time in 2010 as part of the Direct Access Code. And since then, it actually took about 7 years for it to actually come into effect in law, which was from 1st of April 2017. So now the situation as of today is that we do have a statutory GAAR, which is codified in our law. And under the tax treaties, we have also adopted, the PPT test, which is a mandatory or a minimum standard which needs to be adopted. But, before we really talk about, how the interaction works and how one can really deal with the GAAR combined with the PPT test, I think the bigger question also arises is with the PPT anyway being on the, the anvil and with also the OECD proposals, was there really a need for GAAR to be introduced in the domestic law? And specifically when there were really, already anti-avoidance rules in the context of, in the way of SAR, which are specific anti-avoidance rules or targeted anti-avoidance rules. And India was also at the forefront of developing, judicial GAAR principles. So, Varsha, I think that's more of a question for you. I mean, you've been following the history of India's judicial anti-avoidance principles over the last few years. So, was there really a need to have a GAAR in, in our statute, and what were the legislators actually thinking of?
Parul, thanks for the introduction and for the question. I think when you talk about the existing pre-GAAR anti-avoidance measures that we had in the Indian law, the word that you mentioned, that specific or targeted, that's really important here, because most of the provisions under the law that existed were intended to deal with specific anti-avoidance situations. For example, your transfer pricing provisions dealt with international transactions between related parties only. And then you also have thin capitalization rules under the law, which check the amount of interest that you're paying out to a related party. So, of course, there were these specific anti-avoidance rules in the statute already. Similarly, we also had specific anti-avoidance rules under tax treaties in the form of your beneficial ownership requirements and limitation of benefit rules, which again were very, very specific. And for instance, if you note the Singapore Treaty limitation of benefits provision, it has a number of specific requirements that need to be met for a company to be able to qualify that provision. Right? When you look at these in combination with the judicial GAAR that has developed over the years in India, the judicial GAAR also, till a few years ago at least, had followed a form of a substance approach primarily. The stress used to be that where the taxpayer does not actually flout specific provisions of the law actually permits the taxpayer to undertake that action. And hence, that action would not be seen as an abusive transaction. The origins of this principle, we all know, are in UK cases of Westminster and McDowell. And it has developed over the years in the UK and parallelly in India. And through the Supreme Court cases in Azadi Bachao and in Vodafone, where the look at principle is what has been expounded upon. Why this developed into the need for the Indian government to actually enforce a GAAR in its law is that is the same reason why there's been a global shift towards countries wanting to enforce their own version of anti-avoidance rules, which is this very formalistic approach to anti-avoidance has created a lot of loopholes and opportunities for businesses to very cleanly avoid the letter of the law in setting up or figuring out ways to have, achieve their tax goals and tax benefits without really flouting the letter of the law. And it was felt that quite globally, it was felt that what is required now is a rule which applies generally across the board and is more intent-based and substance-based in its approach towards avoidance, so that countries don't lose out on their tax base. With that, Parul, I'm going to go back to you.
Right. Thanks, Varsha. So we know that we have a GAAR in place, but I think the bigger question that really comes in one's mind is that, now if we look into the future, what needs to be done and what actually is happening. We cannot really look into the future without really seeing how tax authorities are really looking at GAAR and applying GAAR in the current context, and then apply those principles or those learnings to, any future transactions or any future business propositions that get developed. So, Anandu, I'm going to turn to you for this part. Now, where existing investments and structures are concerned, and, we do have a lot of investment which has historically come in from Mauritius and Singapore into India. And investments up till 2017 have been grandfathered. But could you just lay out as to, how GAAR provisions are likely to impact existing investments and structures, and, whether these investments have been grandfathered or not grandfathered, and what exactly can the tax authorities do and what are they really doing?
Thank you, Parul, for the introduction and for the the question. I'm reminded of, I'm going to paraphrase George Orwell when I say that all investments are equal, but some investments are more equal than others. Because what we know is that GAAR isn't going to affect everyone equally. The good part is, as you've rightly, but the grandfathering is actually is a limited grandfathering, and it's important to note that the grandfathering only applies for any income from a transfer of an investment made before April 1, 2017. So if you made an investment before April 1, 2017, and you receive any income from transferring that investment, then that income will not be subject to GAAR, is what the grandfathering says. But it's interesting that for income that is not of the nature of a transfer that arises from, say, routine sources of income like interest or dividend, the grandfathering provision isn't so clear. And the other thing to point out is that even though the law provides for a grandfathering, there's a specific carve out that says that if a tax after April 1, 2017, then the GAAR will continue to apply regardless of when the investment was made. So it's important to assess how the grandfathering actually works in practice, because it should be borne in mind that not all kinds of income is grandfathered. Some income is not grandfathered. And that's an important aspect to be kept in mind when looking at existing structures. The other thing when it comes to grandfathering that's important to consider is, we know that India has entered into the MLI. The MLI has come into effect rather in India with effect from the 1st of April, a couple of weeks ago. There is no grandfathering provided for under the MLI for existing domestic GAAR. So, question that we've seen come up recently is, how does the principal purpose test under the MLI apply for existing investments? I mean, are all past investments now going to be reassessed on the threshold of the PPT, or is there a sort of an implied grandfathering there? Parul, I think I'm going to quickly ask you that question for existing investments through.
Sure. Yeah, and I think that's that's a very important question, and that is something which is on everyone's minds right now. That while there is grandfathering for under the treaty, under the existing treaties, but under the MLI there is no provision for as such grandfathering of a PPT test, and there is grandfathering from application of the GAAR as well. So you could possibly have a situation where a pre-2017 investment is being sold, let's say in the year 2020, and while the capital gains which are arising from sale of investments by, let's say, Singapore entity are exempt under the treaty and also exempt from application of GAAR. However, the question that arises is whether the PPT does apply or not. Now, if you look at the PPT test, the PPT test has two limbs to it. The first limb to the PPT test is that it needs to be, reasonable to conclude that one of the main purposes was to obtain a tax treaty benefit. And the reasonable test is actually quite, it's quite a low threshold, and it will be quite easy for tax authorities probably to prove that the entity was set up in order to obtain tax benefits. But there's also a second limb to the PPT test, which requires that, taxpayers, if they prove that the benefits which are being given are in line with the object and purpose of the relevant provisions of the tax treaty, then in that case, irrespective of why the entity was set up and for what purpose, the benefit of the tax treaty should still be given. Now, when we look at this object and purpose limb, which is attached to the PPT test, the question that really arises is that, is the object and purpose of the tax treaty to provide a grandfathering for pre-2017 investments? And if that view is taken, then, possibly, one can argue that the benefit under the Singapore Treaty should still be available. But I think this is still, Anandu, in my view, it's still a bit of a question mark, because what really is the object and purpose of the treaty? Do you go back to the preamble to look at the object and purpose of the treaty? The capital gains article in itself may not really have its own independent object and purpose. So this will still remain a question mark, and that is something which one will have to deal with when talking about transfers happening from a Singapore treaty perspective.
Thanks, Parul. You mentioned the principal purpose, and I think that's a good way to take a look at how the GAAR works here, because the department can't invoke GAAR in every case. As we know, there is a twofold. First test is the tax benefit test, and the second test is called the tainted elements test. So what the tax benefit test says is if the main purpose of an arrangement is to obtain a tax benefit, then that's the threshold requirement at which GAAR can be invoked. Now, the tax benefit test has to be looked at with the tainted elements test. The tainted elements test, in addition to obtain a tax benefit, does the result of misuse or abuse of the act? Does it lack commercial substance? Is it bona fide? So what the tainted elements test really looks at is to see if the substance on a substance over form analysis, is there substance to the transaction? And substance here, of course, is different from our normal understanding of economic substance. This is commercial substance that needs to be looked at. But I think we need to emphasize a little bit on how the tax benefit test works here, because like you've said, the PPT under the MLI model looks at one of the principal purposes, one of the main purposes. But unlike that, the domestic GAAR focuses on the main purpose, which, if you look at it, is a much more narrowly worded test, because the sole principal objective of the arrangement needs to be to obtain a tax benefit for GAAR to be invoked at the threshold. And in that sense, it's a little more beneficial to the taxpayers than the test under the MLI. The second thing to look at is what exactly is a tax benefit. Now, the Act, the Income Tax Act, does define the term tax benefit, but it's an extremely broad definition. So any reduction in tax, any avoidance of tax, any deferral in tax, even whether that's under the Act or under a treaty, amounts to a tax benefit. So even if you're not actually reducing the tax liability, you're just changing when the liability is incurred, that amounts to a tax benefit. Any increase in the total loss, any reduction in the total income, all of it is considered to be a tax benefit. So even the smallest reduction in tax could be construed as a tax benefit by the tax authorities here. Having said that, there is a de minimis threshold that applies. We know that GAAR can only be invoked if the tax benefit involved does not exceed the sum of INR 3 crore, which is actually quite a small sum if you think about it, because the threshold applies on an arrangement level basis and not at a party level basis. So if the tax benefit for the whole arrangement exceeds 3 crore, then GAAR applies. So in a practical context, from an international standpoint, for cross-border transactions, the threshold is likely to be of little effect. And that's the de minimis threshold that needs to be kept in mind for invocation of the GAAR. Now, once the tax benefit test and the tainted elements test have both been satisfied, you have to look at what the tax authority can do to the arrangement in question. And they have been granted very wide powers under the Income Tax Act to recharacterize the arrangement or to disregard certain entities that are involved in the transaction. They can reallocate incomes and expenses between the parties. They can look through corporate structures. Varsha mentioned the look at test that Supreme Court has evolved through several cases, most recently through Vodafone. But what the Act allows the parties to do is, or rather allows the tax department to do, is explicitly look past the corporate structure of a transaction. And that's a key point to be borne in mind there. And the last but not least, the most important point from a cross-border perspective is GAAR specifically permits the tax authorities to deny a treaty benefit if both the above elements have been satisfied. So wide powers have been granted to the tax department to recharacterize transactions, but that power is subject to certain procedural safeguards. So in practice, if in the course of assessment or at any point the assessing officer decides to invoke GAAR, there's a two-level inquiry that happens, because primarily the assessing officer has to seek the permission of the principal commissioner of tax or the commissioner of income tax, and seek his approval to invoke the GAAR. There is a hearing that happens there. The principles of natural justice are followed, and the taxpayer is given an opportunity to present his case and explain why GAAR should not be invoked in that case. But if the commissioner is of the opinion that GAAR nonetheless needs to be invoked, a referral needs to be made to an approving panel that is specifically has been set up to approve cases where GAAR is going to be invoked against parties. Now, the approving panel is comprised of a retired High Court judge, a senior member of the IRS, and a tax expert who is knowledgeable in the field of direct tax, of finance, of international trade. It's similar to how the Authority for Advanced Rulings works in the sense that it's a quasi-judicial body because the retired High Court judge is presiding over it. Once again, the panel will convene a hearing and hear both sides, both the tax department, the assessing officer, and the parties, and decide if GAAR is invoked. So there are some procedural safeguards there, and it's only after this two-step inquiry is completed that GAAR can actually. The last point I think I wanted to mention is on how this is going to play out in terms, because we know the form that companies have to file was amended a couple of years ago to seek information relating to GAAR. It was deferred once, it was deferred a second time, and it is now finally in force with effect from the 1st of April 2020. So companies are now required to self-report any impermissible avoidance arrangements that they may have entered into. They have to identify the fact that they've entered into an arrangement. They have to describe the nature of the arrangement, and they also have to say how much tax benefit has arisen out of that arrangement. So it's really a self-reporting system. I'm not sure how effective this is going to be in practice. So for existing investments, I think these are the sort of steps and the safeguards that can be kept in mind, Parul.
Sure. Thanks, Anandu. And I think before we move on, we have some questions from from our participants, and we can just quickly go through those questions. So one of the questions is with respect to although transfer of investments are grandfathered up to 31st March 2017, arrangement before this date and any benefits arising after 1/4/2017 is not grandfathered. Can department argue investing through a particular jurisdiction can be treated as an arrangement? So transfer of investments are grandfathered if in case the investment has been made prior to 2017 and then the transfer happens post 2017. Of course, if GAAR does apply, then tax authorities can argue as to whether a particular location has been used. In fact, there was a clarification circular which was issued by CBDT, which dealt with this particular issue, and it also talked about that if a particular location has been used for the purposes of making an investment, then they will look at the commercial rationale of using that particular location, and it will depend on facts of the case. There's another question on if buyback is better than dividend, does it automatically mean tax benefit is the objective, and what is the basis of substantiating the commercial rationale? So again, there's a CBDT clarification which is that the method or the manner in which a transaction is taken, that should not really attract GAAR, but we don't really think that we can just go simpliciter by that statement. And if buyback is really better than dividend, then some commercial rationale may need to be demonstrated, at least to be sure that in case if tax authorities do come up with with a GAAR, then we are able to justify it. I think that the burden of proof is also on the taxpayer, and we'll talk about that also subsequently as we move ahead. Anandu, one question for you, which has come from one of our participants, is that you talked about this GAAR panel, and do we know whether any cases have been taken up before the GAAR panel, and how they're dealing with these cases?
We aren't aware of any cases that have been taken up by the GAAR panel. That information is not publicly available. But what we do know is that the Authority for Advanced Rulings is currently looking at a couple of advanced ruling applications on the question of tax avoidance. So I think over the course of this year and the coming years, we will see more and more cases that both the approving panel and the Authority for Advanced Rulings are going to take up regarding GAAR and tax avoidance.
Right, right. And I think that leads us to, what Anandu, what we are hearing from you is that while we don't really know how the GAAR panel is going to deal with these cases, but looking at the recent jurisprudence, whether it's the AR or the other cases, some cases have come about at the NCLT level as well. Is that, can we really draw inferences from those type of judicial precedents on how GAAR will be implemented, learn from those cases, and then decide how to deal with GAAR when we are carrying on our transaction? So Varsha, what are your thoughts on that? And could you just take us through on what really has happened thus far on certain jurisprudence which may not really be directly on GAAR but may impact the way GAAR may be looked at?
Sure, Parul. So as you mentioned, the GAAR was initially proposed under the law in 2010, and it's been in the making, evolving till about the 2013 when we had the latest version, which is as it stands today. So there's been a long period of time where advisors like us, businesses, have been looking at the provisions and trying to understand how they will operate in any transaction situation or any cross-border structuring situation. And as Anandu right now took us through the provisions, there are a lot of provisions and a lot of words and phrases used in the statutory GAAR provisions, which are open to interpretation and are causing a lot of concern in the sense of businesses being worried that they're going to affect the way that they have been carrying out business or are intending to carry out business. This brings us to your question of what can we look at in terms of guidance currently to be able to interpret these statutory provisions. As we right now discussed, there is no jurisprudence on GAAR at present. It's still too early. And the only guidance we have on the Indian GAAR provisions per se are the CBDT clarifications that have been issued. And the CBDT clarifications that were issued in 2017 are a series of clarifications in question and answer format, where the CBDT has picked up certain queries that were raised by the industry and tried to respond to them. And a lot of those responses are framed in ways that may not necessarily be helpful in terms of being conclusive. For instance, when questioned as to whether a specific anti-avoidance rule or a limitation of benefits provision will be enough to preclude the application of the GAAR, the CBDT responds that where these provisions are adequate to cover anti-avoidance, the GAAR will not apply. However, it's an open question, and my understanding is a factual determination as to when a specific anti-avoidance rule or a limitation of benefit provision will be adequate to cover an anti-avoidance scenario. That said, what we can look at are jurisprudence in India on anti-avoidance outside the GAAR statutory provisions. And we can also look at some jurisprudence from outside of India. Now, jurisprudence from outside of India may not necessarily be conclusive or very helpful to us because of the nature of the GAAR provisions. The GAAR provisions are inherently protectionist, and hence they are a function of a domestic legislation and domestic tax policy of a country. And hence it's understandable that it would differ from country to country. Just one look at provisions of anti-avoidance that have been adjudicated upon in other countries like Canada, New Zealand, and UK, at the very first glance kind of tells us that there is a vast variety in which these countries are looking at anti-avoidance. Canada has, since the very initial cases that we all know of, such as Canada Trust Co., etc., has been expounding on a form over substance approach. They have been looking at a reasonableness threshold when looking at anti-avoidance cases, and usually they interpret these situations to the benefit of the taxpayer. Now, this is one end of the spectrum. There are other standards that have been developed judicially by other countries. For instance, New Zealand has a standard called the Parliamentary Contemplation Test. And what the Parliamentary Contemplation Test says is where a provision is used in a manner that could have been within the contemplation of the parliament, it will not be a case of abuse provisions. Also, when a situation of avoidance is merely incidental and is not the main intention of the parties involved, that will not again be a case of avoidance. The UK also follows a form over substance principle, as has been established with its judicial decisions. But in 2013, the UK also introduced a statutory GAAR. The US is one country that has sort of been taking a different path compared to the rest of the world. The US has very clearly not signed up to the MLI and not been a party to the principal purpose test determination. But the US has also legislated a number of protective anti-avoidance measures of its own, like the base erosion and anti-abuse tax, and also introduced further more stringent controlled foreign corporation rules, many of which were legislated in the recent Tax Cuts and Jobs Act. So looking at foreign jurisprudence may not be so informative to us in interpreting how the Indian GAAR works, because there are a lot of nuances that are different in the way certain provisions have been drafted. But what we can look at is certain cases under Indian law, primarily cases which have been recently adjudicated on by the Authority for Advanced Rulings. The AAR is a forum where the GAAR wouldn't necessarily be the provisions that are being looked at. But as we know that in order to approach the AAR, one of the qualifying criterion is that there can't be a prima facie case of tax avoidance. Now, true that this can't ipso facto apply to a GAAR determination because of the number of criterion that have to be satisfied in order for a transaction to be declared an impermissible avoidance transaction. But it will be informative to look at these cases simply to see where the Authority for Advanced Ruling and the Income Tax Department and the judiciary is going in terms of its thought process on anti-avoidance. A few of the recent cases that have come out in 2019 and 20 are the SR case and the much more recent Bidwest case. And what is very important to note in these cases is there may not be any judicial principle which has been very clearly stated by the AAR. But what has been stated by the AAR is the importance of the facts involved, and which is why we come back to the discussion on the importance of documentation and commercial rationale. Because if you look at the Bidwest decision, what has been key in that decision has been the chronology of events involved. The AAR very clearly makes a timeline of what happened when. It notes that the Mauritius entity in that situation was set up just 2 months after a bid was already entered into, and the entity was just inserted over there in place of the existing South African entity. And this was a key issue over there because South Africa-India tax treaty didn't really provide for any benefit, but the Mauritius-India tax treaty did provide for more beneficial terms. And looking at the fact situation, the AAR came to the conclusion that this was a clear case of tax avoidance. Also going back to a case of X Limited, which is a little dated in terms of the fact that it was in 1996. Again, the chronology of events is what was very, very crucial there. It looked at the chronology of the revision of tax treaty between UK and India, which was in 1994, and how 1 year right after that, the Mauritius entities were set up. And they were set up just because the ultimate shareholder, the bank that was created in UK, could not take benefit of the tax treaty anymore because of the revision in the UK and India tax treaty. And hence it had decided to set up Mauritius entities in between that could claim the capital gains tax benefit that was available at the time. Recently, looking at cases like Bidwest, we've also come to note that simpliciter cases of treaty benefits under Mauritius are being denied. what has become very important and what has become very crucial are substance and beneficial ownership criterion under tax treaties, even for pre-GAAR cases. To this extent, Anandu, I do have a question for you. Do you think that this shift and the challenges to tax treaty benefits that are coming out now are an outcome of the GAAR or are aligned with the invocation of the GAAR in any manner? And what do you think can be done to substantiate these treaty benefits?
Well, Varsha, whether it's an outcome of GAAR or it's a coincidence is anyone's guess. But the interesting thing to note here is that this pattern repeated itself once in the past, because in 2012 and 2013, when the GAAR was first introduced, and when Justice Balasubramaniam was the chairperson of the AAR, a large number of cases were rejected at the admission stage on the basis of tax avoidance. And this question happened then: is it because the GAAR has come into place? We're seeing a general shift in terms of substance over form. So are courts being a little more reluctant and hesitant to answer such questions? I don't really know if it's an outcome of GAAR, but there's a very clear shift in terms of how Indian courts are looking at it. Particularly, we know from our experience with the AR at least that Mauritius-based applicants are not being seen positively. Increasingly, there is a suspicion that Mauritius-based companies are being set up specifically to avoid tax. Often the AR starts from a reverse onus point where it tells the applicant that the burden is on the applicant to prove that the transaction is not designed for avoidance of tax. And like you pointed out in the case of Bidwest, there were a couple of other decisions recently that the AR has looked at specifically in the context of Mauritius, where they've said unless there's very clear-cut documentation to show that there was commercial substances setting up in Mauritius, operating in Mauritius, the income being earned in Mauritius, we are not going to look at it positively. In terms of what can be done for existing investments, it's all we keep saying that documentation is important, and I want to just expand on that a little bit by saying the documentation can be in the form of board minutes, income recognition on the books, fund flows, financial statements. The old days where we could just show a TRC and say, Azadi says TRC is sufficient to prove beneficial ownership. I mean, I'm afraid those days are now behind us. So unless you have definite documentation showing that there is substance in Mauritius, it's not just a shell entity in Mauritius. It's good to always show infrastructure, employees, expenses. Particularly operating expenses are a great sign that the company is an operating company in an offshore jurisdiction. So those, I think, are what existing investments will need to demonstrate to cross the threshold of GAAR or tax avoidance in today's day and age.
Thanks, Anandu. We have a bunch of new questions in the chat window. There's one question from Agrima. Is the GAAR panel's decision applicable to all similar transactions, or does it work like the AR in that it has no precedence value for other transactions? Anandu, would you like to take this up?
Yeah, in fact, it's a good question. It works exactly like the AR. The binding of the ruling of the approving panel is binding on the taxpayer and the revenue authorities in relation just to that taxpayer. But I suspect, much like the AAR rulings will be considered persuasive. If they are published, if they're made public, then certainly the department is going to look at how the approving panel has looked at past decisions as a persuasive interpretive method.
Thanks, Anandu. So carrying on in terms of statutory or judicial guidance outside the GAAR provisions and what we can use to inform our understanding of the GAAR provisions. Another instance where the GAAR has been invoked, although in a certain tangential form, is in case of certain merger approvals before the NCLT and NCLAT. Two cases come to mind. One was the Ajanta Pharma case, where the income tax department invoked the GAAR provisions, although from our review of the order, there doesn't seem to be a very clause by clause or very detailed invocation of the GAAR. However, what happened in Ajanta Pharma was that there was what was sought was a merger between a holding company and its subsidiary. And the income tax department argued that GAAR provisions would get triggered because the manner in which the merger was being undertaken would result in an avoidance of the then dividend distribution tax, and also capital gains tax that would have been payable on sale of shares otherwise. The NCLT order does not mention the GAAR and does not really look into the application of the GAAR in the fact situation. But what the NCLT order did do in that case was that it said that the rationale for the merger was not adequate to justify the tax avoidance that was involved. Now, this is a tangential invocation of the GAAR outside the procedural safeguard of the GAAR panel that Anandu mentioned. And at the time that it was invoked, it did cause some concern, especially because this was one of the first instances of the GAAR being invoked. In another case, in the Reliance Jio mergers case, there was a proposed merger of 3 Reliance group entities. Income tax department in that case sought to invoke the GAAR, saying that there was a proposed conversion of redeemable preference shares to loans as part of the merger, and that would effectively be a conversion of equity to debt, which would reduce the outflow of dividends in the company and hence result in an avoidance of dividend distribution tax. Then NCLAT and the NCLT in that case, although did not again go into the depth of the GAAR provisions and their applicability, did not accept the income tax department's contention and allowed the merger in that case. The reason I mentioned these situations is because this is a situation where the GAAR provisions have actually been invoked or sought to be invoked by the income tax department in a completely defensive manner outside the GAAR provisions and the GAAR procedural safeguards. And it's concerning in the sense that it appears that the GAAR is being used as a tool against taxpayers by the income tax department and not in a manner that perfectly follows due process of law. The CBTT clarification that was issued in 2017, specifically, there was a question asking whether when an NCLT approval has been accorded to a merger, can the GAAR still be applied? And the CBTT's response was that if the NCLT has adequately and explicitly considered tax implications while sanctioning mergers, then the GAAR will not be applied. Again, this use of the term sufficient, adequate is a very wide term, and we don't know what would count as adequate or sufficient for purposes of the tax department. Since this brings us to the foray of M&A and domestic M&A in particular, Parul, I would like to ask you that in this domestic M&A sphere, can you shed some light on what considerations are now important from a GAAR perspective, and how companies should be looking at it and how companies should be looking to navigate it?
Right. Yeah, sure. Thanks, Varsha. And I think this reference to, the different cases that have happened recently, all the more from an NCLT perspective, they are extremely important. And the reason also for that is because, the CBTT has actually clarified that if an arrangement is sanctioned by an authority such as the NCLT, and the aspect of tax avoidance has been explicitly and adequately considered in sanctioning such an arrangement, then GAAR will not apply to such an arrangement. But I think the question also that arises there is, when do you really say that an NCLT has adequately considered, the question of applicability of GAAR? When it comes to actually doing domestic restructurings, and a lot of times we see that, a lot of restructurings happen for consolidation of entities which serve multiple purposes. One would be the consolidation, and the other would be, also to have some sort of a tax benefit, which could be in the form of carry forward of losses, or it could be also, to put the entities under a tax treaty jurisdiction, and so on and so forth. Many times these restructuring transactions entail different steps. And, your step one could be a merger or a demerger, which could be followed by, let's say a capital reduction, or it could be followed by a buyback of shares, where typically there could be a step up that could be accorded, on account of the first transaction which has been incurred. From a GAAR perspective, what really needs to be kept in mind is that, the GAAR provisions actually acknowledge transactions can be undertaken in different steps, and they shift the burden on the taxpayer to prove that the entire transaction, they can combine all the steps together to show that, the purpose of doing the transaction, the entire transaction, or even one step in that transaction is not for the purposes of obtaining a tax benefit. And here, it gets slightly tricky, because what sort of a cooling off period should you keep in between two restructuring steps of a same transaction? Is it, should it be 5 years? Should it be 3 years? Should it be 9 years? And there is no really set principle for any cooling off period. Tax authorities can also combine the steps irrespective of the cooling off period, of course, provided that the statute of limitation has not really crossed. And another point that really needs to be borne in mind is that specifically if there is a tax treaty which is involved, the principal purpose test does not really look at multiple steps to a transaction. And, the principal purpose test, being a much wider test than GAAR, could apply only, even if one of the main reasons for doing the transaction was to take a tax treaty benefit. But this could be one instance where GAAR could be wider than a PPT test. And, let's just talk about that through an example. Let's say that there has been a demerger of an undertaking into another company, which is followed by a capital reduction. And the capital reduction is, entails some sort of a treaty benefit on capital gains tax. It's possible that the PPT may not really apply on the second limb, but the GAAR could still apply. And, so one should not really ignore the GAAR where PPT is involved. The both can apply in tandem, the both can apply separately. And what really is important is, again, looking at the Agenda Pharma ruling, whether we look at the NIT ruling, this, proper housekeeping along with the commercial rationale is really the key to all restructuring transactions. And I think with that, there are also, some questions which we have got on the screen. And Varsha, I'm going to turn over to you with respect to, we just spoke about main purpose versus one of the main purposes. Do you really want to take up Saurav's question on the main purpose versus one of the main purposes?
Sure, Parul. So Saurav's question, for the benefit of all our attendees, is whether the main purpose versus one of the main purposes, can it be where there are multiple main purposes and it still satisfies the main purpose and there's an overlapping scenario and not a broader scenario? So Saurav, thanks for the question. I think the terminology of the GAAR provisions is very important here. And it's important more so in light of the previous versions of the GAAR and in light of the way the principal purpose test is worded, which are much broader in terms of the purpose requirement. The GAAR clearly says the main purpose, and if we go back to the expert committee report or the Shom committee report, it actually looks at the previous version of the GAAR, which said one of the main purposes needs to be to obtain a tax benefit, and it recommended that this was way too wide in terms of its applicability, and that the GAAR should be limited to situations where the sole or the dominant purpose of an arrangement was to obtain a tax benefit. in 2013, when the amendment was actually made in the law, the memorandum to the Finance Act actually takes cognizance of this Shom Committee finding, and it's on that basis that the scope of the main purpose being the sole or dominant purpose has been revised. So while one can't give a conclusive answer as to whether it'll just apply in situation where the one main purpose is to obtain a tax benefit, it's still with a lot of comfort that one can say that it's much narrower in its application from this standpoint compared to how the PPT or previous versions of the GAAR would have applied.
Right. Thanks, Varsha. I think maybe we can, talk about, we have a few minutes left, and I think the question that's really coming up is how should businesses really deal with the changing landscape on tax avoidance? Given the uncertainty of how the PPT rule will apply, given the uncertainty of how tax authorities are going to be really applying GAAR, how should we address GAAR for future investments? We talked about the importance of documentation, but in what manner should we really be documenting? How should housekeeping be done? Are there different aspects where we talk about sale of investments? So, Anandu, very quickly to you. What is your thought on what really can be done, and then we'll move on to Varsha and try to wrap this up.
So Parul, I think just off the top of my head, 2 points. One, of course, we mentioned the importance of substance, and it's crucial to note what kind of substance we're talking about here. It's not just business purpose; it's more substance over form. So if the form of the arrangement is different from what the arrangement actually achieves, then you're concerned. So you must ensure that A, you have commercial substance. B, it's documented. It's documented very well. Recitals are important. In agreements, in contracts, documents of all kinds to show that what you're doing is commercially justifiable is important. The second point that I want to briefly mention here is regarding beneficial ownership. We've increasingly seen cases where courts have focused on beneficial ownership instead of legal ownership. And this is very common, particularly in a cross-border structure where there are multiple entities at multiple levels and multiple jurisdictions. Who is the ultimate beneficial owner? Who is actually receiving the income? This is obviously from a treaty standpoint, this is important for sources of income like dividend, interest, and royalties. But increasingly and concerningly, we're seeing beneficial ownership being applied to cases of capital gains, where gains from the alienation of investments, which are typically not subject to a beneficial ownership requirement, are being asked to justify this requirement. So beneficial ownership, I think, is litigated as we move forward, and that is also something the parties should be keeping in mind. So those are the 2 points from me.
Right. Varsha, what are your thoughts on, what should businesses really be doing in order to prepare for GAAR and specifically for future investments?
Right. Parul, I think the one thread that we throughout our webinar has been the importance of documentation and the robustness of it. Obviously, saying that there should be robust documentation cannot be the end of it. It is also the qualitative nature of the documentation that really matters. What needs to be captured going forth in all sorts of restructuring exercises is the commercial rationale involved. And this can differ based on the type of transaction involved, right? So for instance, in intra-group transaction, what is the main thing to be justified is the arm's length nature of most of the payments. In this situation, it's very important that all intra-group transactions are happening at fair value and are supported by very well detailed valuation reports that are supporting the value of the transaction. Other forms of documentation can be board minutes and detailed agreements, maintaining internal memos and communication between parties, just also internally in a company, say when they're taking a decision to invest in a particular manner. For instance, investing in equity versus debt, what could be the rationale of each? The kind of facts that can be mentioned to support these could be certain group policy measures that are taken, undertaken all throughout the world, or certain industry practices that are prevalent that make that decision not a decision that has been spurred solely because of tax benefits. What is also very, very important going forward is to evaluate in detail TT eligibility. And we've been speaking about LOB requirements, we've been speaking about the GAAR PPT applying, and this kind of changes the entire pre-existing format of restructurings that we have had, where Anandu rightly said that based on the Azadi case, a TRC was adequate to gain a Mauritius treaty benefit. That is no longer the case. It's being questioned left, right, and center. And treaty, even tax residency certificates granted by another sovereign are being questioned in terms of their validity. So these are the points from me, Parul.
Right. And I think what is really important is that, where GAAR is concerned, the burden of proof lies on the taxpayer. So it's really on the taxpayer to demonstrate the commercial rationale of the transaction. There's also a distinction between substance and commercial rationale. And this is what we see a lot, in private equity transactions, specifically when there is sale of shares of an Indian company from a Mauritius or a Singapore entity to another person, and when these investments are even grandfathered. We've talked about the position that AR has been taking on these investments, but in order to prepare one for GAAR and to to really prepare one for GAAR and to see how the transaction should be dealt with. Due diligence is really important on that entity. The second part is that, good housekeeping is extremely important. While we are talking about documentation with respect to the transaction, but ever since the investment is made in the first place and subsequently, that investment is then sold, tax authorities are looking at the journey from the source to the sale. And in that context, good housekeeping on a year-on-year basis is extremely important. From a buyer's perspective, indemnity is really important. I think we also had a question on indemnity by one of our participants. And indemnity provisions, we are seeing that indemnity provisions are really being negotiated to tooth and nail in order to really, prepare oneself for any demand that may come out in the future. And this is all coming on account of the uncertainty that is coming out of GAAR. What one can expect is that because of the PPT rule, even bona fide commercial transactions may come under the ambit of PPT, which is just the treaty GAAR. And so therefore, commercial rationale, whether one is setting up an entity in a foreign jurisdiction, the manner in which the transaction is taking place, and the contracts which are being entered into with all the parties, all of those need to be looked at and need to be done as if the transaction is happening with the third parties, and the purpose of doing the transaction is merely commercial and tax is just an ancillary benefit. And I think if we do that, then restructurings may still be possible. But of course, like we said, documentation is really the key in order to get through these, the muddy waters. And we thank everyone, for being part of this presentation.